Hello and welcome. Before we jump in, just so you know, this explainer was prepared by Samir Aurashani, PhD, with some AI support.
All right, so today we are pulling back the curtain to explore the hidden value in companies. We're talking about those incredibly powerful assets you can't see or touch. That's right, we're diving deep into intangible assets, and the most mysterious one of them all, Goodwill. So let me just ask you, when you think of a company's most valuable asset, what's the first thing that pops into your head? A giant factory, maybe? A whole fleet of trucks? A big shiny skyscraper headquarters? And yeah, those are all valuable, for sure. But what if I told you that the most critical assets are very often completely invisible?
And that leads us perfectly into our first section, the untouchable assets. Right here, we're going to define exactly what these invisible yet incredibly valuable assets really are.
So, what is an intangible asset? Well, the official definition is an asset that has no physical substance. You can't kick it, you can't weigh it. But what it does do is grant its owner some crucial rights, privileges, and a huge competitive advantage. Just think of the secret formula for Coca-Cola, or the powerful brand recognition of Apple. That's where the real value is hiding.
Now, for something to be an intangible asset, it has a few key characteristics. Of course, it has no physical substance, and it represents special rights that usually come from a legal contract. But here's the most important point. It has to be identifiable. So what does that really mean? It just means you can separate the asset from the company itself. For example, a company could sell one of its patents to a competitor, or it could license its brand's trademark to be printed on a t-shirt. This idea of being separable is absolutely key, and you'll see why it's such a big deal when we get to our final topic.
Okay, so if you can't physically touch them, how on earth do you account for them? That's what we're digging into next, accounting for the abstract. Let's take a look at how we measure and record value that you just can't hold in your hands.
You know, surprisingly, the starting point is actually very familiar. It's just like how you'd record a new delivery truck at its purchase price. Intangible assets, they're first recorded at their cost. And cost here means a lot more than just the price tag. It includes all the money it took to get that asset ready for use. We're talking legal fees for a patent application, registration fees for a copyright, the whole shebang.
So what happens after that? Well, you've probably heard of depreciation. That's how the cost of a physical asset, like that truck, gets expensed over its useful life. For intangible assets, we do the exact same thing. We just call it something different, amortization. It is the same exact concept, though. You're spreading out the cost over the time that asset is helping you generate revenue. This all ties back to a fundamental accounting idea called the matching principle, where you make sure expenses are matched to the periods they actually benefit.
But here's where it gets really interesting, because not all intangible assets are created equal. This brings us to a tale of two lifespans, where we're going to explore the critical difference between the assets that expire and those that could, in theory, last forever.
This is the big divide. On one side, we have assets with a finite life. They have a limited legal or useful time limit. Think of a patent or a copyright. Because they have a clear endpoint, their cost gets amortized over that lifespan. Makes sense, right? But on the other side, we have assets with an indefinite life. There's just no foreseeable limit to how long they'll be useful. And because they don't run out, we don't amortize them.
Let's look at some real-world examples of these finite life assets. A patent gives a company the exclusive right to produce something for 20 years. Boom, clear end date. A copyright gives legal protection for the whole life of the creator plus another 50 years. Again, it's a long time, but it is a defined period. Now, research and development is a bit trickier. Most R&D costs are just expensed right away. But certain development costs for a product that you can prove is technologically feasible can sometimes be capitalized as an intangible asset and then amortized.
Okay, let's flip to the other side, the indefinite life assets. A perfect example is a trademark. These are the words, the symbols, even the little jingles that immediately make you think of a particular company. You know, like the Nike swoosh or the McDonald's golden arches. As long as a company is actively using and defending its trademark, that legal protection can literally last forever.
So trademarks and trade names are a prime example of indefinite life assets. So are franchises. Think about the contractual right to open and operate a Starbucks or a Hilton hotel. Or you might have specific operating licenses, like a TV station's license from the government to broadcast on the airwaves. As long as the terms of the deal are met and renewed, these assets don't have some built-in expiration date.
And all of that brings us to our final and maybe most fascinating category. This is the special case of Goodwill, and it is truly the most unique intangible asset of them all.
So, let's go back to that rule we talked about earlier. We said intangibles have to be identifiable and separable from the company. But what about an asset that represents a business's entire reputation? Its amazing management, its prime location, its super loyal customers. You can't just sell that separately, can you?
Well, that unique asset is called Goodwill. It's the value of all those good things taken together as a whole. It's the company's secret sauce. And here's the most important rule of all. A company can't just create goodwill for itself out of thin air. It is only recorded on the books when one company purchases another entire business.
So how is it calculated? It's actually just a simple leftover amount. Let's use a real-world example. When Disney bought Lucasfilm for about $4.05 billion, Disney had to figure out the fair market value of all of Lucasfilm's identifiable assets, the rights to Star Wars and Indiana Jones, the technology, and so on, and then subtract the liabilities. The amount that Disney paid over and above that calculated net value, well, that gets recorded as goodwill. It was the premium Disney paid for Lucasfilm's creative talent, its reputation, and everything else that made it a powerhouse.
And just like our other indefinite life assets, goodwill is not amortized. It's just assumed to last. However, and this is a big one, it has to be tested every single year for what's called impairment. This basically means the company has to check if the value of the business it bought has gone down. If the future prospects or reputation of that purchase company have dropped, the value of the goodwill on the books has to be written down, which then gets recorded as a loss on the income statement.
So the next time you choose a specific brand of coffee or find yourself staying loyal to a certain type of phone, just ask yourself, what is the invisible value that I'm really paying for here? It's probably a powerful, intangible asset that a company has spent years and years building up.